You do not want to miss this episode. We're going to talk about the ideal corporate structure, and we've got one of the top accounting minds in the country with us today. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell. Joining me as always, Christina White. Christina, how you doing today?
Hi, Darren. I am doing great today. I'm super excited to do this podcast with our guest. And actually, we're not just going to do this one podcast. We're going to do a whole series on accounting questions that I hear all the time that I think are going to be super helpful. Like this series is going to be super helpful to our listeners. And I'm excited to dive into this one, the corporate structure. That's a big question we hear all the time. So super excited to introduce our guest and dig into this.
All right, so I'm super excited to have Bob Gauvreau here from Gauvreau Accounting, Tax, and Advisory Services. Christina, before we bring Bob on, anything else?
Oh, yes. I do want to remind everybody that if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All right. Okay, so let's bring him on. Bob Gauvreau. Bob, how you doing today?
I'm doing fantastic. Excited to be here, guys. This is going to be a lot of fun.
Yeah, so we met you at the multifamily conference, and we've been in touch a bunch since then, and we just marvel at the work you do. We get so many clients and prospects asking us, "How do I do this? How do I do that?" And you seem to have all the answers, so it's you're perfect podcast guest. So, Bob, why don't you tell us about a little bit about your accounting firm and what parts of the country you work in, and what services your firm offers?
Yeah, and if you're good, I'll give you maybe the little extended
Sure.
story, maybe just a little bit about the startup. The only reason I talk about that is, business owners. I'm a business owner too. I'm not necessarily an accountant, although I play one on TV. I understand the pains and the processes of trying to grow a business and create wealth. So we're in the same journey together. I started this in 2008. I started out as a CPA focusing on tax planning for small businesses. I left a large multinational firm because I didn't feel like I was getting to focus on the group that I wanted. You start working with public companies, private sector, government agencies, and that wasn't my passion. It was a small business owner. And so started that firm all by myself. I actually had one person at the beginning. We've now grown it to be a team of 105 professionals. We do offer full CPA services. We've got dozens of CPAs that are here. We have a boutique tax firm that focuses primarily on tax planning, specifically related to corporate tax planning for business owners. We've got a law firm in-house that we service Ontario with any sort of real estate, corporate, will, estate planning related work. We can also work with incorporations across the country as well. So helping support business owners with that business structure. We've got full bookkeeping services. We've got an online coaching program that helps business owners understand the key skills they need to go from zero to, an 8-figure business like we are. So that's a little bit of the longer story. But for sure, it's been an exciting journey focusing specifically on working with those business owners. And maybe the last little piece I'll throw in is we also offer US services as well for those business owners who are looking to expand south of the border.
Love that. I love that you have it all in one spot because as business owners out there, you're so focused on growing your business. You're so good at your business. And then you hit a spot where you're like, okay, in order to grow this, we're going to need to add some services and you just don't know which way to turn, right? So it's nice that you have that all in one place for somebody to be able to come to and experts. And being a business owner yourself, that's so important, right? When you're picking someone that you want to work with, I always say you want to be working with like-minded individuals. And I knew when we met you at the multifamily conference, I was like, this is a like-minded individual. He also thinks tax is your number one wealth destroyer. We're definitely going to get along.
Yeah, absolutely. It's funny too, though, because, I wouldn't say that I'm the most favorite person amongst the accountants in the world because we're doing things differently, right? We are bringing everything in as a one-stop shop. It's threatening to other people, but a lot of accountants just say, guys, I'm an accountant. I sit in a room and I tick boxes and I do filings and that's all I do. We like to focus on the planning and the value creation on a go-forward basis as well. But to your point, Christina, the one-stop shop has sort of been an evolution based on necessity because when we've been working with other practitioners or professionals, we've been looking at it and saying, well, we're constantly waiting on other people. What if we were just continue to evolve this so that it is a one-stop shop? And the last piece I forgot to mention is that we do business valuations as well. So that's a big component of a requirement for tax planning, is sometimes freezing the value of a business. So we do have that as well. Yeah, it's an exciting spot to be. We're at about a 37% growth rate this year, focusing on helping more people. We're on a mission to empower all entrepreneurs with the right financial information to make informed decisions and change the world. And I'm excited that we get to do this together.
Yeah, I just think that you've got a perfect combination, because I see so many business owners, they start out and they're small, right? And they have sometimes a glorified bookkeeper, the small town accountant or whatever. And then they get to a point where they become more successful. They realize they need new accounting stuff, but then they also need maybe a tax strategy piece, and maybe they need a bookkeeper, and maybe they need some coaching. And all of a sudden they're trying to find 4 and 5, 6 different people, and to try to coordinate all those people and try to get them all on the same page. You're never going to have them in the same room. And the advantage of working with a firm like yours is you've got everything in-house there. So, if you need to know what the corporate structure is, you've got the legal department over there, and you've got the accountant department, you've got the bookkeeper department, everything's together. I think that's one-stop shopping is what entrepreneurs are looking for, right? We've got enough balls in the air. We don't need to juggle 6 more with 6 different advisors.
That's exactly it. And some people have their advisors, they come to us for accounting and they're like, well, we really like our lawyer and we want to continue working with them. We're like, great. That's fantastic. We have a legal firm to offer if people are looking for an alternative. We're not necessarily advocating for a switch on that side. We're just happy to be here to support these transactions. And to be honest, a lot of lawyers, to the same point that you're talking about, Darren, as accountants, a lot of lawyers get pigeonholed with certain expertise in certain areas. Real estate, for example, right? We work with a lot of real estate investors, and they're working with a real estate investor expert as their lawyer, which is fantastic. But if we need to go change their corporate tax structure, the real estate lawyer is not well versed in that. So we've got the ability to step in and support that lawyer with their client and work with them on the tax side, and they can remain with their regular real estate lawyer for all the other transactions. So it's sort of a nice complementary service to almost add in where maybe the lawyer that you're working with doesn't have the skills to do what we need them to do in a corporate tax plan.
Love it. Love it. Okay. So we wanted to talk about corporate structure today, and I get to ideal corporate structure, but start us out sort of, what's a typical corporate structure when an entrepreneur starts, maybe like a lot of us 1 and 2 man companies or 2 people companies starting out, then all of a sudden they have growth, and they're good, they're growing, and then they come to you. What would be a typical structure that somebody would have where they've had lots of growth, but they really haven't done any planning since they started day one as a one person show?
Yeah, and I'll maybe even take it a step earlier too, Darren. When a lot of people get started, they're like, okay, we're just going to start. We're just going to start selling. We're going to start collecting money. And then they start collecting money. They forget about, whether they have to charge any sales tax, GST, HST, QST, whatever that looks like. So that becomes a problem. And then they get to the end of the year and they're like, oh man, what do we do about taxes? That's a problem. And we see people who aren't properly planned right out of the gates. They start to have challenges very early with cash flow because the government's taking everything. And it's super difficult to grow your business if the government is taking the majority of the funds that you've got in your bank account. So the one thing I would say, and this is a question that is probably the one I get the most, is when should we incorporate? And a lot of people say, it seems like it's complicated, which it somewhat is, but it's not. It's like a short-term complication. But when should we incorporate? And the answer varies based on who you talk to, but I'll give you the real answer. Because I don't want any of this BS that accountants say, oh no, you have to have $500,000 in revenue before you incorporate. Revenue has nothing to do with why you would incorporate. Other people say, oh, you have to have, leave all of your money in the business to incorporate. Not necessarily the case. You have to pay X amount in tax, or you have to have a certain number of employees. It's irrelevant. right? The real reason of when you should incorporate is when your personal tax rate gets above 12.2%, which is the fixed corporate tax rate for the first $500,000 of taxable income. When your personal tax rate gets above 12.2%, you need to incorporate. So that is a point where all of a sudden you're going to be able to find tax efficiencies. Now, there's reasons as well before you hit that 12.2% that you should do it anyway for protection and asset preservation. You know, we've got a business that, depending on the risk level, where all of our assets are on the line as a proprietor. So when we set up a corporation, it isolates our risk of that business inside that entity. So hopefully that answers one question, but maybe I'll just lead into, you know, what the corporation sort of looks like, because a lot of people say, well, it seems complicated. It's really not. At the date that you incorporate, we can't backdate it. You have to choose a date in the future, now or future forward. We incorporate, and it's just like when you're born. When you're born, you get a birth certificate. It says who your parents are. It says where you were born. The corporation gets the exact same thing. Who are the original directors? Where was it created? What was the date it was created? And now you've got a separate legal entity aside from you. And once we get that set up, we've got protection against anything that really happens within that corporation. So all of our personal hard work and assets are taken care of and protected outside. So tax rate for sure. Fairly simple process. We have to do bookkeeping for a proprietorship or a corporation. It's the same. You know, there's no extra process there. There is a separate tax filing because it's a separate entity, and the tax filing is a little bit more complicated than a personal one. But for the most part, that is, you know, phase one. Get that corporation set up, and then we start looking at more advanced structures. Once you start creating a little bit of momentum and the business starts making money, we start building up some cash resources. And now we have new complexities that we need to deal with, complicating the structure a little bit more from there.
Okay, so like the step one would be we call it an opco or operating company. You know, Canadian controlled private corporation, first 500,000 at 12% ballpark, depending upon your province. So that's sort of step one, and then when do you start getting into additional corps or additional planning instead of just having that operating company set up?
Yeah, no, great question. So there's sort of two approaches to this. You know, there's my preferred approach, and then there's the approach that most business owners take. Guys, as a business owner, we're in this to win it, right? Like, we're committing to this. This is a long-term investment for all of us. My opinion is that you get the holdco and likely a family trust structure set up from day one. The reason being, it's going to be way less expensive to do it now when your business has no value versus having to revalue your business, go through a corporate restructuring, freezing the company, and doing it later. You know, you're looking at about 10 times the cost at a later date versus upfront. Now, a lot of people are going, well, we're not really sure where this is going to go in the short term. So we want to make sure that we're being as efficient with our costs as we can. We set up the opco. Totally fine. You know, but if our plan is to really build something, then we should be thinking about what the structure needs to be 10 years from now, not just when we're starting. But to answer the question, Darren, when should that structure be appropriate for most people? When we start to accumulate surplus cash in our bank account. So let's say, for example, you know, you've got a business owner, they're doing $200,000 or $300,000 in revenue, and they're maybe starting to profit $100,000 or taking 50 out. They've put a little bit of cash, they've left it in the company. Once that happens, we've now got a risk inside the business that if something happens, we've got all of this surplus cash that we worked hard for that's sort of on the line that somebody could sue us and take it away. We don't like that. So that would be a time when we want to look at creating a secondary structure to get that cash out and protect it in a separate entity. So really, from a business standpoint, that's sort of the trigger point that would say, okay, if we don't have this in place from day one, when we start accumulating surplus cash in our business, we should be looking at setting up that holding company.
All right. And you're saying when you do that initial holdco, it's important to set up the family trust as well? Because that's a big question we get. People are like, I'll set up the holdco, but why would I add that family trust portion to it?
For sure. So let me before I answer that, Christina, let me just share with people the cost of what we would typically charge, just to get an idea, because I think
I
that's a
like it.
fear,
Yeah.
right? So every entity that we would set up, it's about a $2,500 fee. So you set up the operating company, it's $2,500. You get it registered, you get your business number, you get your minute book, all the resolutions, you're ready to go, and you're compliant with all of the regulations under the Ontario Business Corporations Act. When we set up a holdco, exact same situation. What's the difference between a holdco and an operating company? Some might say nothing really. The name of it and its intention. The same bylaws are in place. There's no restrictions. Essentially, it's just a separate entity to hold your funds. People ask, what is a holdco? Well, it's really just the name that you've attached to it. It's a separate entity. There's no difference. So you're $2,500 to get that set up. And then a family trust is also $2,500. So if you're thinking from day one, what would the cost be to have the ideal structure set up from right out of the gates? You're about $7,500. Now, I say that the reason that we want to look at some of these extra structures, like a family trust, and I'm definitely going to send you guys a diagram that you can include here, so that people can start to get a visualization of what it looks like. But when you have an operating company owned by a holding company, what happens is you're limiting your lifetime capital gains exemption that you're able to when you eventually sell and exit. If you don't own those shares and your holding company owns those shares, you're not likely going to be able to get access to that lifetime capital gains exemption, specifically if your holding company is holding all of the cash, which is why it would be set up in the first place. So one of the setups that we sort of differ with most practitioners is we put the operating company in there that is owned by the family trust. Now, the reason we put the family trust in there is that not only you as the shareholder can get access to your lifetime capital gains exemption, which is $1.25 million of tax-free money, but as your family trust, all of your beneficiaries, spouse, kids, they can all be in there. Parents, the dog, the cat down the street, really, as many people as we can get in there to be a beneficiary. You get access to 1.25 million of lifetime capital gains exemption for each of those, as long as they haven't used it. So, and I say dogs and cats and kids down the street somewhat jokingly, because we do have to allocate proceeds to these people. They can gift it back to us, but there has to be somewhat of a trusting relationship in there to utilize them as a beneficiary. So like keep that in mind as well. But then you might say, okay, well, where's the holding company? Where does it come into play? Well, we actually set it up as a corporate beneficiary of the family trust so that you can essentially, as a business owner, you want to get that cash out to protect it. So let's say you have $100,000 in your operating company. You can issue a dividend up to the family trust that goes up to your holding company. No tax on that transaction. There's no due to froms. There's no assets or liabilities showing up in your operating company that make everything an absolute mess. It goes directly from your operating company up to your holding company, and it can be invested in there. So that's where you guys come in, right? So you work with them. The holding company is where investments, life insurance policies, those are being held up there. The reason we want that is that when you guys go to sell your operating company in the future, you're keeping all of your life insurance and your investments, all of that hard-earned work. You don't want that to go anywhere. That's staying with you. And because they're separated, when you sell your operating company in the future for $10 million, you've got 8 beneficiaries, you pay no tax on that transaction. Somebody takes the business over, you get all of that tax-free money personally, plus you've got all of your investments that you've earned and created over a period of time in your holding company. So now you carry on with way more money in your pocket and very isolated, protected investments. The only other thing I'll say, and I think this is important as well, when you start thinking of when should we create this more complicated structure, if you have too much cash in your business, you actually lose your eligibility for your lifetime capital gains exemption. So for example, if you have $150,000 of cash or a life insurance policy or investments inside your operating company, and you go to sell that company for $1 million. At the time of disposition, more than 10% of the assets that are in that company are non-active business assets. I know I'm getting a little technical here, but they're non-active business assets because they're investments. And what that will do, it will disqualify you from getting all of your tax-free money. So I say all of these things more so to say, you need a personalized plan. You need to work with an advisor who can come up with the appropriate structure for you. But if you're not having the discussion about a family trust and a holding company and you've got surplus assets, you're missing out on an opportunity and you're likely putting yourself in jeopardy of a lot of risk and some tax inefficiency in the future.
I love that. So let's talk about that capital gains exemption when you go to sell your business. So if I just have an operating company and I've got a bunch of cash in there because I didn't want to spend $2,500 to set up another structure or something, and then I sell my business for like 6.25 million, great. I'm thinking I'm going to get some portion of that tax free, and the reality is none of it will be tax free, and I'll pay tax on that 6.25 million. Versus if I have an operating company, a family trust, and a holdco, and the money flows up properly through the trust to the holdco, and let's say I have a family of 4, and we'll just keep it simple, husband, wife, 2 kids. Now I sell that business for 6.25 million. I'm going to pay $0 in tax.
Well, if you've got 4, it would give you 5 million. So this is where you said, I'm going to make this simple
I'll give
for
you
you.
5 million. Okay.
Darren, when I say simple, I use $1 million because it's simple for my mind. You went 6.25.
Well, I thought it was
All of a sudden, I'm like Rain Man over here.
Maybe I was thinking 5 people. All right, let's start at that again. So let's just say I have a $4 million business, $5 million business. All right.
Yeah.
So five the number?
Five is perfect.
All right.
Yeah.
So I got a $5 million business. I sell for $5 million. I just have an operating company. I'm going to pay tax on $5 million. If I have an operating company, a family trust, and a holdco, now I sell it for $5 million. I can use 4 capital gains exemptions for me, my spouse, my 2 kids. $5 million completely tax-free to me. So $5 million tax-free or $5 million taxable?
At 33% now with the new capital gains rates. So now I don't want to throw in too many complications, but in theory, what you said is 100% true. The one thing the government throws in, it's kind of this is where Justin and I don't get along very well, right? Justin and I are not friends. I've gone to Ottawa to try and see if we can get into a disagreement on the streets, but I can never find them. But anyway, what happens when you have that large of an income and none of it is taxable on your tax return? So for example, each beneficiary is claiming 1.25 million in proceeds, capital gains, 0 tax on it. They hit you with this weird little tax called alternative minimum tax, and it kind of messes some stuff up. But I only say that because, if someone is listening to Darren and I chat about this, and all of a sudden they sell their business and all of a sudden they have this alternative minimum tax bill that comes up, I don't want them to come back and go, you guys said that there was no tax on it. Now, ultimately, the end result will be that there won't be any tax. They hit you with alternative minimum tax in year 1, and then you get it refunded as long as your income isn't substantially high and no tax owing over the next 5 years. So there is a sort of short-term prepayment that we get back. So at the end of the day, you're right. That family for $5 million, they get 100% of the proceeds tax-free into their pocket versus paying 33% because the structure wasn't right. So, and I think, Darren, where you're going with this is for a $2,500 one-time upfront investment, doesn't it make sense to do this right out of the gates? And my answer would be yes. I know there's probably a few listeners out there going, you said 12% or depending on the province, like Darren said, but I'm continuously paying 50% on my income tax for my real estate investments. And the answer would be yes and yes. Unfortunately, passive investment income is taxed at a higher rate than active business. They want to incentivize business owners to grow their business, to reinvest in people and whatnot. And they want to tax the hell out of those that are wealthy and have passive investment income. So how do we do better? And the answer is quite easily, actually. What we typically would do is, again, depending on the situation with each real estate investor, you want to set up a corporation especially if you're a business owner who's getting into real estate investing, right? You've got all this corporate after tax money. The moment you take it out personally, you get hit with tax. So you don't want to take the tax out and then buy the property personally. It's so inefficient. We set up the corporation to buy the real estate in. The real estate is then now earning money and being taxed at a 50% level. Well, here's how we get around that. Even if you have an active business and a real estate company, we charge fees, we call them management fees, from your active business into your real estate company so that we draw down the passive investment income. So the tax rate that's at 50% goes down, and we bring in more active, which is consulting fees or administrative fees or, cost recovery of supplies and resources that are helping that investment company. And now we're paying at that 12.2% tax rate. So effectively, we're getting rid of about 35% tax by just making that shift. But I think the important part is for real estate investors, especially if you have a business in place, you need to have a corporation own this property. Otherwise, you're just going to have excessive amounts of tax inefficiency. And maybe I'll just dive a little bit deeper in that for one quick second. So active business, we're paying our 12.2%. So we've got 88% tax after tax money in our business. And we want to put a deposit down on a real estate property. If you take that out of your business, you're going to pay upwards of 43% personal tax. So let's say we're now at around 45,000, 50,000, which is where we would end up. We've now got a $50,000 deposit personally for a property, or we've got $88,000 of deposit money inside our corporation to make a larger deposit. We can invest in larger investments. We've got more capital to contribute. We're paying way less tax. And the beautiful part is our wealth will accumulate significantly more if we can avoid that 35% personal tax rate in there. So the strategy for real estate investors, make sure that you have your corporation set up so that they can essentially work with each other. There's no tax on transferring funds from one corporation to another as a loan. Now, if I go back to my family trust structure in here, what I would say is with our family trust in place, we can actually eliminate those intercompany loans that are back and forth that don't look so great to the banks. With the family trust structure in place, we can eliminate that altogether and continue to fund those real estate projects with pre-tax money that we're earning in the business. So real estate investors, getting your structure right is super important. One, use a corporation, take advantage of that. Two, let's make sure that we're focusing on eliminating some of that passive investment tax, and we're focusing on maximizing our active business tax. Huge efficiency there, and lots of savings on the table.
Okay, so back to that ideal structure now. So I've got OpCo, I've got family trust, I've got the holdco. So I'm a business owner. I've got investments, I've got insurance in my holdco. Is the real estate going in the holdco in this case, or is it another corporation I'm going to open up for the real estate, or does it depend upon how much real estate I have?
Yeah, it really depends, Darren. And this is where, and I'll maybe even expand on that a little bit too, but this is where it comes down to having a good plan for you individually. Like what are we trying to accomplish with this? The one reason that I would advocate that people would have it in a separate corp versus where they would have their cash and investments is real estate is still a little bit of a risk. We've got tenants that are in properties. I've had stories where roofs have collapsed. People have had damages, lives have been lost, lawsuits in real estate. If there's any form of negligence that's in there, your assets are completely wiped out. Insurance is great until it's not. So if we could set up a secondary structure to make sure that our life insurance and our cash investments are protected in a separate corp and our real estate's in another one, I think that's the most effective strategy. And from a planning and risk management standpoint, I think it's really important to have that set up that way. Let me just, about the complexity of this structure. So if we think about it for a moment, what is the necessary step right out of the gates if people want to take advantage of this type of structure? They have to have their OpCo in place and their family trust. If they don't need a holdco because they don't have surplus cash yet, that's okay. We can easily add it in later. So one of the ways that we structure our family trusts is that if you have a spouse, or if you don't have a spouse, it could be a future spouse. If you don't have kids, well, it could be future kids. It could be future grandkids. So we can write in the legislation in the trust agreement to allow for all those things to happen. Same with a holding company. We can write in any future holding company owned by, the main trustee that's managing the trust. They can automatically come in as a corporate beneficiary. So really, out of the gates, you're $5,000 in setting up that structure. We can set up a holdco later. And I say that because I also want everyone to know, I know entrepreneurs, right? I kind of live and breathe that a little bit too. We don't typically stop at one company. So you typically put your tentacles into other entities as well. So it's really easy once you have that family trust in place. Every time you go to start a new entity or work with another one, or a partnership or whatever it is, our family trust just subscribes to that ownership on a go forward basis. It's very, very scalable, so that we don't have to do a lot of complex revaluation or anything during the process. As long as we have that trust in place, we can continue to make it as complicated as possible. So just to maybe give a mental visualization, I've got a few clients who have upwards of 20 ongoing entities that are businesses, and their family trust owns the shares in all of those entities. And these guys are definitely going to max out their lifetime capital gains exemptions with their beneficiaries without question. But the idea is they don't know which one is going to be first. So when they're looking at building these companies, they go, well, we don't have a plan to sell any of them in the short term, but that could change. And what we want is, so the first, 1.25 million per beneficiary, that they don't pay tax on any of that early money. And then it's set up for greater efficiency and transferability and whatnot. Just to say that it's very scalable for everyone, right? It doesn't increase the complexity. Yes, there's an annual filing with a family trust. It's $1,000 a year. But outside of that, there's no additional complexities with it.
So when you're setting up these corporations, I know there's different schools of thought. Like, people always ask, how do I pick my corporate year end? Right? Like, some people it's December 31st, just like their personal tax. Other people go 4 months before, after, some other when you set it up. In a perfect world, what would be the ideal, in your opinion, ideal date to have your corporate year end?
Well, Darren, this is where I get a little selfish. So as a practitioner who has, 2,000 year ends that we do, I would say 35% of them, maybe 40% of them, have a December year end. So, in an ideal world, if we wanted to have more time with everybody working on tax planning, it would be a non-December year end. So a lot of clients ask me, well, what would you want? And I go, well, June 30th sounds pretty good. It's on the opposite end of that one. We would have the ability with a corporation, you don't have to pay your taxes owing for 90 days. So that's September 30th. And your filing is December 31st, 6 months. So that's a better time for us. But I feel like it has to be somewhere in the middle. If you can avoid December, I think it's a good opportunity to avoid it, because that's where everybody plays. But I would look at it, as the cycle of your business. When would you have the most sort of cash after a heavier season, potentially? If you've got a real estate agent, for example, they come through the summer, they close out their commissions. The real estate market's hot. In September, they have all the cash and they start to get less busy. So that's a really good time to file your taxes, because the opposite side of the year, if we're doing their taxes and we're filing it in May, they've had no money come in for 4 months. They're starving to death. And then we give them a tax bill for $40,000 because they had a really great year last year, but they bought a really nice car. That's a problem. So, I think it's dependent on the business. Always have it in a period where maybe it's not your high point, but somewhat following your high point, so that we can make sure that they have the resources to easily pay it. And then they know this is our after-tax money that we can work with after the fact. The other part is, when people incorporate, a lot of times what we say is you have 365, I think it's 368 days from the date that you incorporate to have a year end. So a lot of times if somebody were to incorporate, August 29th, for example, I would say, okay, well, we're going to pick August 31st next year, which is within that 368 days. So we're going to extend your year end as far as we possibly can before we have to give the government any money. And so August 31st next year, then we have 3 months to pay. So we're getting, 18 months out or 15 months out here. So it's just deferring our tax liability. So a lot of times when we're doing planning, we're working with clients on that. If they say, well, it doesn't matter to us, logistically from a particular date, then we'll say, well, we'll make it 12 months from the date you incorporated. Push that tax bill out as far as possible.
Okay, I love it. Well, I could talk to you all day, but I want to start just wrapping up here because we're going to have a series with Bob. We're going to talk about how to minimize tax for business owners. We're going to dig into a lot of tax topics for real estate investors and business owners. But just on the ideal structures, or anything else that we missed today, Bob, that you wanted to cover?
Yeah, no, like this is one consideration, right, Darren? And there's a number of them, which we're going to talk about in the series. Something we need to talk about is the succession, what goes into that. Other components, compensation strategies. How do we actually get money out of this company? How do we maximize our wealth accumulation by using this? I think the fundamentals of what we've talked about today with the operating company and the family trust, there's a lot of value in there, especially if we want to be able to split that lifetime capital gains exemption. Not everybody is saying we're going to sell our business for millions of dollars. But why not? Like, why aren't we planning to sell our business for millions of dollars? And let's take that one sort of proactive step now in order to eliminate a significant amount of tax at the end of the day. So I think what we talked about fundamentally is fantastic. For anybody listening, you guys just need to be thinking about this and say, what are the opportunities for me to make my structure better? Because what I don't want to do is give Justin 33% of what I've worked so hard for if I can avoid it. And there are ways to avoid it. So just keep that on your radar and know that possibilities are out there to make your situation better than it currently is.
Oh, absolutely spectacular information. So Bob Gauvreau, we get the link down below to get a hold of you and your firm. How else can people follow and learn more about you, Bob?
Yeah, definitely check out our website, gauvreaucpa.ca, which the link will be provided here. Follow us on our social media channels. It's at GauvreauCPA. We've got a YouTube channel. We're on all of the major platforms. We're putting out content and teachings every single day. We've got blog posts. We've got a lot of media articles. I write for Forbes and Entrepreneur Magazine occasionally, not as much as I should be, but I do it every now and again. So check us out. We're always putting out content. We're just trying to help entrepreneurs understand how they can create their wealth in a greater way with greater tax efficiency and ultimately so we can change the world together.
That's it. Thanks for watching. Thanks for listening. I hope everyone has a great day.
Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.